Good afternoon, everyone, and welcome to this webinar on our Best of BlackRock series. We will be hearing from Emily Fletcher and Sudhaif Niaz, who will be talking around BlackRock Frontiers. BlackRock Frontiers has what we think is a unique investment universe, and it has delivered strong returns over the past 3 years as emerging market indices and many funds have struggled. Despite this, the shares currently trade on a discount of around 10% to NAV, which may interest investors with a long-term view. Before I hand over to the managers, just a reminder that if you'd like to ask a question, please write it in the box on the right of your screen. We have around 30 minutes reserved for the presentation and then 15 minutes or so for questions. So over to you, Emily and Sudhaif.
Thank you so much, Thomas, and good afternoon, everyone. It's fantastic to be here. Just to start with a bit of an introduction, my name is Emily Fletcher. I've been at BlackRock for 17 years and working in these markets relevant for this trust for pretty much all of that time.
Hi everyone, my name is Sudhaif Niaz. I've been working with Emily for the last 8 years in the emerging markets team, looking primarily at the Middle East and the ASEAN regions.
Fantastic. And before we kick off and go any further, we'd like to just echo what Thomas has said, in that we love answering questions. So please do keep the questions coming in throughout the presentation, and we will try and answer as many of those as possible, and really try and make sure that the presentation is tailored to your interest areas, as we have probably a too large ability to speak endlessly. So please do keep those questions coming in. So to kick off in just setting the scene for what this trust does and where it invests, we are really looking to invest in really, I guess, a predominance of the world. So we don't invest in the developed markets, and we also take out the top 8 largest emerging markets from our universe. So we take out China, Korea, Taiwan, India, we take out Russia and South Africa, and we take out Brazil and Mexico from our investment universe. And we would invest anywhere else in the world within and see that sort of as the area where we invest. We think that that's a really interesting place in the world to be investing, really because very few other people are solely focusing on this part of the world. So if you look at the majority of emerging market funds, around 85% of their benchmark would be in those top 7 countries. And we think that therefore that probably equates to around 95% of where most emerging market analysts and portfolio managers spend their time is focusing on those larger markets and what's happening there. And therefore we think that these areas where we invest, so these smaller countries, are therefore relatively overlooked and under-researched, and that therefore they actually make fantastic places to be making alpha. And it is much easier for us to be finding alpha in these markets where no one is looking than it is, for example, in the US, where there's a lot of people and a lot of analysts, a lot of very smart people investing. So that is part of the reason why we really like this area of the world and why we're focusing on and investing in this part of the world. So I'm going to take you through a couple of reasons that we're positive at the moment on this part of the world, a couple of areas that we think are really interesting, and then we'll come back after that to a little bit more sort of how we do things and sort of long-term structural drivers for these countries. But to take you first of all through some of the reasons that we like them at the moment, and number one would just be that we see a very big differential between where we are on interest rates in the developed world and where we are on interest rates in emerging markets. If we go back in time, then about the beginning of 2021, we started to see inflation rise across the whole world. And what was different about the markets where we invest is that the central banks there generally started to raise interest rates coincidentally with that. Whereas in the developed world, they didn't start to raise interest rates until about 12 months after that. So very much raising rates at a lag to inflation in the developed world, whereas very much coincidentally in the emerging world. And you can see that actually we are in a position, we have been for some time now, that emerging markets are actually running positive real rates. So they have interest rates that are higher than inflation. It's been particularly the case throughout 2023, as inflation peaked in the majority of our markets, the end of March, beginning of April this year of 2023. And we did start to see interest rates come down, the first tentative steps towards that in the summer in August. And why is this interesting? So for the majority of the countries where we invest, and actually what you can see on the screen here really is mainly the larger emerging markets, but it's very much true in the smaller emerging markets, probably even more so where we invest. What that actually means is that rates are high. They have been high now for a fairly extended period of sort of 12 to 18 months. And that has meant that the majority of these economies have actually already slowed. Whereas in the West, we're still having a debate about whether or not high policy rates will have any impact on the economy. That's not the case in our markets. These economies have generally already slowed. And as a result of that, we're in a position where inflation has come down pretty significantly and looks to be likely to continue to trend down. Here much more driven by food inflation, where we see much weaker soft commodity prices, and that will be a much bigger portion of the inflation basket. But it's also been driven by the fact that throughout COVID, these countries were much less able to have governments that really gave out handouts to support their local economies. Not because they didn't want to, just because they didn't have balance sheet ability to be able to do that. They didn't have, are not able to use the US dollar and print dollars in order to be able to help their populations. So that was a very much a weakness of the system. And I think it has ended up transitioning to be a positive in terms of thinking about these countries. Where we are at the moment, we're still at a place where rates are still pretty high. And that means that we think that the bond markets in these countries look pretty attractive. So in Hungary, you can still buy a bond with a 12.5% yield. In Chile, you can still buy a bond with a 9% yield. That's still the highest yield you would have got on a government bond for the last 25 years. So we think it's still relatively attractive, and we expect money to continue to flow into the bond markets in all of these countries. One of our philosophies is that we think that equity markets, bond markets, and currency markets tend to be positively correlated in these markets. And so that point when bond markets start to look attractive, when real rates start to look attractive, is often the time to be starting to think about equities in all of these countries. We would expect, as we go through the next 1 to 2 years, that we would continue to see rate cuts happen across the emerging and frontier markets where we invest. And on the back of that, we would expect to see economies really start to grow again. And on the back of that, we'd see companies grow their earnings. On the back of that, we should see stock markets start to do quite well. So that's the sort of trajectory that we're expecting across the majority of our frontier markets. We come on to the second reason why we think actually countries are quite interesting at the moment. And this is really just where they sit in the global geopolitical, sort of makeup, a split that we see. I think that we are seeing increased fragmentation between East and West, increased policy divergence between the West, the US and Europe, making up predominance of that bloc, versus the other bloc made up of Russia, China, Iran. And you can see here really sort of the way that I think it's one of the recent votes we had at the UN, and you can really see that split between the red and the blue. I think what's also interesting then is that middle ground, those countries that abstained, that are really trying to keep a neutral ground between East and West, trying to attract investment from both sides. And actually the majority of the countries where we invest in frontier markets would actually sit in that neutral middle ground. And there are areas in the world where that can really be to their benefit. And I think the Middle East is one of those. I think that particularly somewhere like Dubai, we think is positioning itself well as a global financial centre, open the whole way through COVID, continues to be open to everybody, perhaps positioning itself as the new Switzerland, place to store your wealth, and a place where both sides can come and access that. And we've seen that, I think, interestingly, in sort of some of the conversations recently between East and West that again have been brokered by some of these middle ground countries. So we think that really puts some of these frontier markets in quite an interesting place to be able to attract investment from both sides over the next few years. But today, over to you.
Sure. Thank you, Emily. So if we flip over to the next slide, 8 on your screen. So Indonesia is one of those countries that we'd highlight that we like today. It's one of the largest absolute weights in the fund today. And the reason for that is, typically if you zoom out of the newspapers and think about Indonesia, it's typically been a boom and a bust story. but we believe that this cycle could actually be different. And the main reason for that is on this slide, which is nickel and stainless steel exports. So Indonesia has found a new $35 to $40 billion export revenue stream through these refined nickel exports primarily, which are being used for NCM batteries, which are being primarily used for electric vehicle batteries, for electric vehicle cars that are being manufactured in different parts of the world. And we think that this new export stream provides support to the balance of payments in an environment where the Indonesian economy starts to grow. Historically, the economy, and even today, has had a lot of import dependency. And we think that import dependency is mitigated by this new revenue stream. What that means is that Indonesia, as you know, is an economy that's very underpenetrated. Population growth is fairly high. So we believe that this economy can grow in nominal terms about 8 to 10% on a sustainable basis, as long as the balance of payments does not go out of whack. What that means is that Indonesian GDP per capita today is something like $5,000, and we think over the next 5-7 years that could double, and that should reflect in the Indonesian economy, in the Indonesian financial sector, as well as the Indonesian consumer sector, which is where we're invested today. If you flip to page 9. Here's kind of a snapshot of Southeast Asia more broadly. So this includes Indonesia, Malaysia, Philippines, Thailand, and Vietnam. And really the key point on this slide is to show you kind of the trend in foreign direct investment into these countries over the last 10 years. But the trend has obviously been positive, and that's a reflection of the policies that these countries have implemented, whether that be to incentivize localized manufacturing, to kind of improve the labor practices. And going forward, we believe, I think the point that Emily made is actually really important, given that some of these ASEAN countries actually sit in the neutral corridor, but in the geopolitical kind of landscape, we think that these countries can actually benefit from supply chains duplicating. And so what that means is that FDI could actually exponentially increase, because if you think about it, the size of these economies is really small. And if you think about the global supply chains, those are quite large. So if they are able to pick up a small share of those global supply chains, that could really benefit these economies. On page 10, so Saudi Arabia, as you know, is the biggest benchmark weight in the fund. It's also one of the large absolute weights that we have in terms of countries. And really the idea here is to show you the transformation that's happened in Saudi Arabia. We'd highly recommend you visit Riyadh whenever you get a chance. Emily and I are actually considering a trip later this year. But there's been an economic transformation, there's been a social transformation, and when you visit, you see that the labor force participation in terms of females, in terms of the local Saudi population, has increased dramatically. Historically, when we go to Saudi Arabia, we'd meet the management teams there, and 8 out of the 10 management teams would primarily be expats. That's kind of flipped over now, where most of them are Saudis. And we think this is a great new kind of systemic change in Saudi Arabia that will bode well for productivity over the medium term. Emily, back to you.
Thanks, Dave. And Saudi recently even won the 2034 Football World Cup. So such a change, I think, from that picture that you see on the left there in terms of Saudi in the early 2000s. And here we have more of our holiday snapshots, just to show you that we don't do any work at all. No, more seriously, we think it's really important to be spending a lot of time on the ground. As we mentioned, as Thomas mentioned, right at the start, he was saying he doesn't think that there are many other funds that have a similar investment universe to what we have. And we would concur with that. We think that's true, certainly not in the investment trust space anyway. But I think more broadly, we don't see many funds that invest in our universe. And that's because it's difficult. There's no economies of scale for investing in this universe. We need to visit 20 countries that have 1 stock each, rather than 1 country that has 20 stocks effectively. And that means spending a lot of time on the plane, spending a lot of time on the ground. But it is hugely rewarding in terms of the opportunities that we can find. Now, we wouldn't invest in a company unless it has fully audited financials. And it's likely that even in the countries where we invest, that those financials will be audited by a subsidiary of the Big Four. And we do spend a lot of time meeting companies, meeting their suppliers, meeting their competitors, meeting political experts, meeting industry experts, meeting regulators, meeting development finance organizations, journalists, students, really trying to build up that really broad, holistic picture of the countries where we are investing. Sam is not on this call, and the reason for that is because he's currently in, I think, transitioning between Thailand and Cambodia, so doing some on-the-ground research. And as Sadaf mentioned, we are about to head off to Saudi in a couple of weeks, and hopefully, if I can get my visa, to Nigeria at some point. It's been harder to get it than I had expected, given I don't think they have too many tourists. So that will taken me by surprise in its visa renewal process over the last few years. But it is important to say that we do spend a lot of time on the ground. We work on a broad team here at BlackRock. We sit within a team of around 25 emerging market investment professionals. Having that depth of team is really important in being able to get the coverage that we do. And I think, therefore, that being part of BlackRock, an organisation that is huge, where we can connect with the debt professionals, with the currency professionals, with the dealers, in-house, does give us that huge advantage. When, as I said, for all of these countries, we're looking to not only do the bottom-up stock selection work and find the opportunities there, but it's also so important that we do understand the macro picture, the political picture, the currency picture, the fixed income picture at the same time. And that's because we are dollar investors, and we need to make sure that the returns that we give are in dollars. It's all very well for me to say that I've made 100% return in kwacha, but if those particular kwacha have devalued by 1,000% over that same time period, you are unlikely to be so impressed with us as investors. Moving on to the next couple of slides, we wanted to give a bit more of a broader context of where frontier markets are currently versus history. You can see that these markets continue to remain cheap, and our fund continues to remain cheap versus its universe and versus wider emerging markets. We continue to find opportunities in these markets. We think that the companies that we're invested in tend to grow earnings around 10 to 15% a year. However, valuations still remain very cheap. I think that's because these markets continue to be overlooked. I think this slide is something that we've had almost since the launch of the trust in our presentation, and it continues to surprise people and surprise us, that despite the fact that we are invested in countries all of which in and of themselves are inherently risky, what is extremely interesting is that our fund in aggregate still has a lower volatility on a day-to-day basis than almost any of the other funds that we run on our team or run in active equities across BlackRock. And it's really because of the lack of correlation between the different countries where we are invested. And what that really means, to explain it a bit further, is that what is happening in each of these countries isn't that important for what is happening in the other countries. So we have elections coming up later this month in Argentina. They will be very meaningful for Argentina, but of supreme relevance to anyone living in Vietnam. We had a coup happen last year in Kazakhstan. Again, very important for Kazakhstan, but utterly irrelevant for the people in Nigeria. And it's really that lack of trade linkages between the countries where we're investing, lack of political linkages between the countries where we are investing generally, that mean that all of these countries are, as I said, deeply risky in and of themselves. But we believe it's really important to be putting them together in a broader, wider portfolio to control those risks. We are unlikely to ever have more than 15 to 20% in any individual country. And that means that when you wake up one morning, you have 15% in, let's take which country should we say? In Sri Lanka. Something we haven't done for a while. We have 15% in Sri Lanka, and Sri Lanka has a coup, and you come in the next morning and the market's down 30%, and the fund has lost 5%, and it would be an extremely painful day. And I hope that nothing that I'm saying is predicting the future, but it is something that would be manageable at the fund level. So it's really important to us that we continue to have that diversity of risk in the portfolio, and we wouldn't typically have more than 5% in any individual stock. To give some idea of performance, over the last couple of years, and we are coming into land in terms of questions. So just a reminder to everyone, please do line up those questions, and we hope there are lots coming in, or we will carry on talking. Let's give some idea of performance over the last few years. You can see it there on the slides. We've had a good performance year throughout 2023, 2020, but the last couple of years, really a very strong recovery on the back of COVID. We haven't seen markets re-rate over that time period in our area of the world at all. So this is really just fundamental earnings growth coming through in our companies and managing to capture that within our portfolios. Look on the next slide again, I think you see evidence of that here, particularly if you look at the dividend accrued in the portfolio to date. We had a period during COVID, I think, when earnings were somewhat constrained. We think we are back now on the point where we have seen those underlying earnings growth coming through in companies, and that is reflecting in the yield that the trust is generating. This is not an income trust in any way. We don't own companies in order to search out income, but it's just a consequence of where we are invested and the valuations of the markets where we're invested, that we do see the nice yield on the trust, which we think is interesting because I think it just pays you to wait in some of these markets. And so to give a summary then of sort of how we think about it, how we put together, what we're really looking for in stocks. We tend to be fairly style flexible. So we have opportunities in the portfolio that are both growth focused and yield focused. In aggregate, we tend not to have a tilt towards yield, really just looking for individual opportunities on the stock level and the macro level for where we should be invested. In aggregate, we think across our universe that valuations are really cheap. And it is interesting to us that you can find this with lower volatility than really in the rest of sort of active equities. It's really important to us that we are active in managing this portfolio. We have a turnover of around 70% a year. We invest in companies with a sort of forward-looking earnings predictions of sort of 18 to 24 months. We don't think we have much predictability for earnings beyond that. That's due to the cyclicality that we think that you see across all emerging markets. So we're very active in talking to our companies, spending time on the ground, understanding the situations that they are in and managing our portfolio reflecting that. We do spend a lot of time on macro in order to generate hard currency returns. And we do think that the investment trust structure is really the best structure to be looking at for these countries, because the markets that we invest in are lower liquidity, the stocks do trade less, and by having that closed-ended structure, it allows us to invest where we think the opportunities are greatest, not where we see the liquidity in order to be able to manage flows in the portfolio. So that's really important to us, and it served us really well over the time that the trust has been launched since 2010. However, we don't believe in perpetual capital vehicles, and so the trust does have a discount protection scheme on it, whereby every 5 years there will be the ability for any investor to exit at NAV less costs. We've had 2 of these 5-year lives so far, and the next one, we're halfway through our current 5-year life. So I think that means in February 2026, there will next be opportunity for any investor to exit at NAV less costs. The exact structure of the exit will obviously depend on the percentage of people that want to do so. And it's not something that we have yet formulated for February 2026, but we'll obviously consult on nearer the time. But that is really important to us because within that time period, and we think that investors should look at this universe with that 3 to 5 year time frame. Within that time period, we think that this is a fantastic vehicle to be managing the trust. If we just flip over the next couple of slides, and we just maybe leave this one up here after a couple of comments for you to look at, and hopefully then we can flip to a few questions. This is giving you the outline of where the trust is invested. You can see the wide variety of countries on the left-hand side where the trust is invested, and hopefully they will majority be countries where you have little other exposure in the portfolio, and this is adding a little bit of colour. So Saudi Arabia, Sinead touched on, Indonesia, Sinead touched on, What we really like about that, I think, is what I was saying around the ability for it to sit in that sort of third realm of the world, ability to store for investors to store some of their wealth there. We think the property market there looks very attractive in terms of demand that we're seeing from customers, in terms of some of the companies' ability to capture that. And we can go through all of them. I'm happy to touch on any of them. People have particular questions about any individual countries. But Thomas, I see that you have come back on screen, which I think it means it's time to go to a couple of questions. So let's do that, and we can come back to some countries if we have time afterwards. Please, Thomas.
Yeah, fantastic. Sorry for interrupting, but quite a few questions coming in already. If you're sitting in the audience, we do have about 20 minutes left, so there's plenty of time. If you'd like to add your question, please do. Perhaps we start quite general. You've got such a wide canvas to cover. How is it possible for you to keep good coverage of such a wide universe?
Yeah, thanks, Thomas. So,
yeah, well, it's not easy. I definitely say that. Emily obviously has a very broad coverage universe, and she's looked at this universe for 17 years. That's quite a long time to kind of build a time series for different countries, macro cycles, political cycles. And the other point I'd make is look, we have a big team. We have the benefit of almost 25, 30 investors in the team across geographies. And all of those investors most of those investors actually have country focus, where they have 3-4 countries that they know really well. They follow the local, economy, the local politics. They visit those countries at least twice a year on average. And so that kind of feeds up into what Emily's trying to do here in terms of managing capital allocation between different countries, and obviously having that prior knowledge helps a lot. So it's not an easy thing to do, but we have a big raw team and many years doing it.
Stone's giving me too much credit, but obviously there are 3 of us as well managing this trust. Sandbeck, who isn't here, myself and Sadek, we all manage this together. So I think that's 3 managers on not a huge trust. I think stressing that it is difficult to do, and there's a lot of information to stay on top of. But I also wouldn't underestimate that benefit of being BlackRock. So throughout the time that we've been here, Sam and I have always joked that VEC Fletcher Capital just wouldn't be able to do this, because the touch points that we have internally through BlackRock are just hugely value add in terms of being able to understand as much information as we need to process to do this well.
Yeah.
Great. There are a couple of questions that might be worth considering together. So one broadly on shareholder protections and corporate governance in your universe, how it compares to the UK, which clearly is a very broad question, but also more specifically, where would you say are the best countries and the worst in your universe in terms of governance and gender equality?
Interesting questions. Yeah, very interesting questions. So I think we'll both need to touch on this one today. In terms of shareholder protection versus the UK, there is such a wide range, I think, in terms of what we see in corporate governance across some of the countries where we're invested in, really from sort of better to not so good. It's something that we are very much aware of, and need to stay on top of. That point around only investing in companies with audited financials is really important to us. That is definitely not a sufficient protection. Although it is interesting to me that in the 12, 13 years since we launched the trust, I think we have had 3 cases of fraud or near fraud or questionable accounting with of stocks that we've owned in our portfolio, and I think all have been stocks that were actually listed in the UK rather than in local markets. But it is something that we really need to be on top of. Part of that is the diligence we do around understanding companies and results and their competitors, and part of that, I think, is around the way that you invest. And I think you always need to be skeptical. Always remember that company management are selling their company to you. That they don't come to a meeting impartial. And if you see the multiple that we have on our portfolio versus the benchmark, we actually are at a slightly lower multiple. I think we have a skepticism against stories thematic stocks, in the market. And part of that is really trying to find the stocks where we think the outlook is asymmetric. So we think that it is more likely that a stock will move in an upward direction versus a downward direction. And part of that is we think is finding opportunities that the market hasn't understood, and that we think are really differentiated. And we think when you can do that, it gives you more protection than being in a very, very crowded stock, which likely has a higher multiple already, where we think that the positive outlook is already more understood. So that I think is part of the shareholder protection. But the other thing to say, the other benefit of BlackRock is we do have a very large stewardship team here. It's around 70 people who are based globally, and our stewardship team would work with us on voting that we do for all of the companies that we own in our portfolios, and really provide the expertise that sometimes Sadaf and myself and Sam don't have in and of ourselves as to what are the best corporate governance practices. When has a director had too long tenure that you wouldn't consider them independent? What does a good board composition look like? What are fair expectations for diversity of board? What are good and poorer minority structures for minority investor structures? And we will be having those conversations with all of the companies across this universe, all the companies we hold in this portfolio, in exactly the same way as we would be doing in UK stocks. We do have some allowance for context. So as yet, most Middle Eastern companies don't have as strong gender diversity on boards as we see in the UK, although I don't think the UK is a paragon of virtue in this regard either yet. But we are asking for an improvement year on year, and we've been really positively surprised in the stewardship engagements that we've had with companies across all of this universe. And I'd say, actually, particularly in the Middle East, over the last couple of years, in terms of companies' desire to really want to change. And so maybe I'll let you talk about some of that a bit, but I think Saudi's been a very positive example there.
Yeah, I think so. So I think just making sure that, one, we understand the incentives that have been put in place at a country level, at a company level, at both of those levels is really important. And that goes back to actually just traveling there, meeting everybody around the company in the sector, trying to get a sense for what the reputation is, what they're focused on, and then obviously identifying key metrics let's say there's not enough independent representation on a board of directors. That's something we'll take up with the stewardship team at BlackRock here in London, and then we'll have a call with the company to engage in that specific topic, just as an example. So it's kind of a mishmash of those things, really.
Great. Picking up on Saudi Arabia, which you spoke about quite positively, someone's asking why you're underweight versus your benchmark, if you have a positive view on the trust. And we also had a question which might tie well together with that, which is clearly with the conflict in the Middle East, have you been reconsidering any of your positions, as you have some quite significant exposure in that region?
Sure. So I'll take the first question, and then Emily can take the harder one. So look, if you go back, let's say 9-12 months, our our kind of investment allocation to Saudi Arabia was actually quite high, around 22%. And that was a reflection of what our fundamental view on the Saudi market and the composition of that market is. If you look at the Saudi stock market, it's basically three pieces. One is the banks. There's a big financial representation. Secondly, there's a lot of petrochemical companies. And thirdly, there's all these kind of domestic, homegrown kind of companies that are focused on the domestic economy. And our view, when our view was positive on the financials, linked primarily to the interest rate cycle that's driven by the US, given that the currency in Saudi Arabia is pegged. And so we kind of represented that view through banks that we thought would benefit from that huge increase in interest rates globally, and especially in the US. And then once that played out, our view is played out, and our stocks are at our target price, and we generally kind of reallocate capital. So that's one. And secondly, as the kind of demand cycle in the world kind of slows down, we've been concerned about the second component of the Saudi stock market, which is the petrochemical companies. And so The fact that we have an underweight there is also representation that we think chemical prices effectively are going to be under pressure, and that hasn't fully reflected in the share prices. And once it does, we can revisit those. So we basically moved the portfolio quite materially in the last 12 months, and that's just a reflection of our fundamental view on the different sectors.
But I think it's a country that we very much expect to return to having more. One, valuations are more attractive, and really we're looking for the two, I think, areas of companies that are attractive, but also valuations attractive. At the same time to one anyway. In terms of the Middle East conflict, I'm sure everyone and us would echo the thoughts of it just being very sad and a huge humanitarian disaster at the moment, and our thoughts are very much with the families who've been affected by it. We are the positives, or the positive is probably even too strong a word. We are taking some relief, I think, from the fact that we haven't yet seen the conflict further accelerate to bring in more countries as yet, and hoping that the longer that is the case, that the less likely that will happen. And so we are that Hezbollah and Qatar and Iran, haven't yet been brought in further into that conflict, is something that it is good so far. And I think what we are wary and watching for is that wider acceleration, and anything that makes it more of that further deepens that split, as we were saying, between the three areas of the world, that the East and the West become brought into this. So it's something we are watching. Would it? I don't think it at the moment has huge impact on our portfolios. We don't have exposure to the countries involved, and we have very little to majority of the surrounding countries. We don't expect it to have a huge impact on the oil price at the moment, just given the fact that within OPEC Plus, we think there's still quite significant spare capacity that they could bring on if they needed to. But we are watching that, and also I think watching in the same way that we are watching temperatures in Europe, where actually I think a very cold few months in Europe could perhaps take us back to where we were 18 months ago discussing the European gas price. And that at the moment seems more likely to be significant. So for us, it's very much in the humanitarian disaster more than market disaster at the moment. But the important thing being really whether we see wider impact.
Thank you. You mentioned briefly in one of your slides the kind of reorganization of global politics and therefore the impact on supply chains. Are there any countries that stand out as benefiting in particular from the growth in India, which clearly is one of the winners in the current environment? India, of course, is in your universe itself, but are there any connected markets?
Sure. So we think certain countries do really stand out as beneficiaries. They would be Vietnam, Malaysia, some of the tech investment that's going in there. Indonesia, as they talked about, some of the nickel for the battery sourcing. Not in our universe. I think Mexico is a huge beneficiary, but we do see in our universe some benefits in somewhere like Colombia. And I think we continue to see some sort of investments into Turkey, Hungary, Czech, Morocco as beneficiaries sort of surrounding Europe. So all of those countries I think would be beneficiaries. India, I would agree, is likely to be a beneficiary purely because mainly because I think it has the population scale that it could take very significant market share. The other countries that we've mentioned, I think will be big beneficiaries because if you think about what could come out of China, only a small portion has to do so for that to be very meaningful for the smaller countries that I mentioned. Obviously, a much bigger portion needs to move for that to be meaningful for India. I think moving into India, you think of the beneficiaries would probably be likely, I guess, around that. I mean, I think could well see beneficiaries into Pakistan, Bangladesh, Sri Lanka, around India. But I think it would probably be in larger emerging markets. So Korea, Taiwan, you would get companies that would be sort of direct beneficiaries of it moving to India, because I think you would likely see the tech investment come from some of the Korean, Taiwan companies that would be owning that production in India, probably in conjunction with local Indian companies. So less probably of India beneficiaries for us, but I think we will likely see some very significant direct beneficiaries. The Vietnam story of the last 15 years obviously has been almost entirely driven by the extent of FDI and the growth in FDI that they've been able to see.
Thank you. On the correlation point, which again I think was another slide you touched on, are the statistics showing low correlation between the fund and the performance of developed markets? And are there any periods in which that correlation has been stronger or weaker?
Yeah, so in the periods of very strong risk off, so GFC, correlations increase everywhere, and the correlation between countries increases everywhere. So correlations are higher, I think, in very extreme events such as that, where I think all markets went down everywhere, and the same will be true in sort of March 2020 at COVID. The correlations were higher because what was affecting markets was a global phenomenon. And correlations are generally lower in sort of more normal events. So we are not saying, and we're really not trying to say, that these are safer markets because volatility is lower. What we're trying to say is that it's very surprising when you take lots of really risky markets. So all of our countries are less developed, have less strong rule of law, have politics that will be much more extreme, and have lower liquidity. So all of them in and of themselves are riskier than your average developed market. But what's really interesting is that you get much more benefits of these correlations, of that diversification, by putting these countries together into a global frontiers fund than you would get by putting various European countries together in a European fund, where they're drivers of that European fund are likely to still be pretty similar across all the countries, whereas our countries will have some bits performing and some bits doing terribly, always, at all points during the cycle, because the economic cycles of our countries are not harmonised.
Turn to a shorter term question. Could you give us some indication of how much the portfolio has turned over the last 12 months or so, and what you would highlight as being the things that you did well and the mistakes? And then together, could you speak a bit about what the kind of thresholds are for adding and eliminating positions or selling? So what are the kind of the key determinants for when you buy or sell?
Sure. So turnover in the portfolio generally is about 70% a year, and that just speaks to the fact we generally have an 18-month or 24-month time horizon for the positions that we have in the portfolio. But so Dave, do you want to talk about some of the areas we got really right over this year?
Yeah, I think so. The kind of big area that we got right, I think Emily mentioned this earlier on in the presentation, was that slide which has the real interest rates in emerging markets versus developed markets. So we saw an opportunity in Eastern Europe in particular, and also in Latin America about 18 months or 2 years ago, where the central banks of these economies, of these countries, moved way ahead of where the developed markets were back then. Why? Because they're used to being more nimble. They expected inflation to ramp up, and in the kind of lead up to inflation, they kind of moved their policy rate way above. So basically what happened is that made the bond markets of these countries particularly attractive. And as Emily mentioned, our investment process is that bond markets in these smaller countries lead what happens in the equity markets. Because if you have an attractive rate of return that you can give bond investors, they allocate capital. When they allocate capital, that increases liquidity, and that kind of flows into the economy. So I think the big kind of investment in the carry countries was a really good decision.
Yeah, as usual, Sudhir's being far too modest. I think we've also had some really good stock selection, a lot of which he has driven over the past 12 months of our returns. We have generally found over history that it's about half from asset allocation from sort of our macro views and half from stock selection. I would say over the past 12 months, that's actually slightly shifted towards stock selection. There's been sort of 60-40 towards stock selection. And that's particularly been driven by some really good stock picking in Saudi Arabia, relative where we picked up a couple of mid caps that have done extremely well. We've also had some wider Middle Eastern industrial exposure that have done really well. Those companies have done well because earnings have been upgraded much more than people were expecting. For example, the Saudi companies have seen earnings growth of, I think, around sort of 50–70% year on year. So really strong earnings growth, which wasn't expected by the market. And so that's the companies have done very well. And as these were companies, particularly in Saudi, that weren't well known at all. So at the same time, we've seen multiple expansion. So the companies have gone from about sort of 10 times PE to 20 times PE at the same time, because investors actually think that a lot of this earnings growth could continue into the future. So a real change in perception by the market of the future earnings power of the companies. But we've also had a retailer in Indonesia that's done very well over the past year. We've had an energy stock in Argentina that's done extremely well. And I think a few others as well. But I would really say that the stock selection that's really been driven actually across the board by our team has been fantastic. And that's been really good actually over all of the regions. And typically we would have one blow up a year, and this year we haven't, so that always helps as well. But we would expect the blow ups, you know, somewhere there'll be something somewhere every year, because there always is, and that's the nature of this universe. And that's okay. That's been normal for the last 12 years, and will continue to be so.
Great. Aware we are a little bit over time. I've got a couple of questions queued up. But if anyone has a final burning question, please do put it through now. We'll make this the quick fire round, maybe. So one question asked: could you please briefly explain how you use derivatives to get leverage?
Yeah, sure. So within the portfolio, we can be up to 10% short. At the moment, we are about 5% short. We do that through CFDs. We do that on a stock-specific basis. We sometimes find that the research work that we do throws up a massively negative rather than positive view, and we just like to be able to capitalise on that. Since we launched the trust, it has been positive, it generated positive returns, but it's small and it's at the margin, and it's not the core of what we do. But we use CFDs for those, which is derivative, but it's a sort of one-to-one exposure. And we can also use those derivatives, those CFDs, on the long side as well. So at the moment, I think the portfolio is net about 110% long, and it's about 115% gross long and about 5% short, to give that 110% net. We tend to use the derivatives, the CFDs, which is this sort of one-to-one exposure, but just not fully funded, in markets where it's operationally very complicated. So, for example, in Vietnam, it's a T+0 market, so you have to put the cash in to the country before you're allowed to trade. It's very operationally complex, so we tend to actually just use a broker to do that in this one-to-one CFD exposure, and they can deal with the operational complication of that. We find it's a cheap way of getting the leverage that we want, because it's completely flexible, that we can take it on and give it back at the times when we want it. And that we're never tied into something at any particular interest rate. So we really like the flexibility of that, because we can just use it as and when we have good ideas.
Are there any frontier markets or regions that you currently regard as uninvestable?
Yeah, Iran, sanctioned countries, nothing else. We don't like the word uninvestable. We think it's red rag trouble for us. Uninvestable gets our ears pricked and thinks, ooh, we must buy something. That means everyone must hate it. There's always an opportunity for those contrarians on a team in places that are considered uninvestable.
And maybe a final question then. So Indonesia or Vietnam on a 10-year investment horizon, which do you think looks most attractive?
So
I think both are fairly attractive. My preference would be Indonesia, just because I think you have a bit more of an institutional framework to kind of have sustained investment inflows. Vietnam, and Emily knows it much better, it just seems a bit more opaque to me. So yes, Samsung has gone in a big way into Vietnam, and then there'll be other investment inflow as well, but just the political setup and how the economy works is a bit more, it's definitely more opaque. So I think that transparency that Indonesia gives, as long as they continue on the path that they're on, I think sets Indonesia up better.
yeah, I agree. Give it another 12 months, I think, before we're really positive on Vietnam. That's the time frame. We're not quite there yet.
Yeah.
Brilliant. Well, thanks both for your time and answering all those questions, and thanks very much to all of you in the audience for your interest. If you'd like to follow up, please do follow up with us via email. We hope you can join us tomorrow, where we'll continue the event discussing BlackRock Greater Europe. So, Emily, Sadaf, thanks very much, and yeah, see you next time.
Thanks very much, Thomas.
Thank you.
Thanks for having us.
Bye.